In our last session, we started to have a look at the idea of double entry bookkeeping in terms of looking at the accounting equation and establishing the dual effect of each transaction and the business entity principle. We also saw in the last session just before this one how to record that dual effect in our ledger accounts. Okay, so in our T accounts as sometimes referred to. We also learnt at that point what is a debit and what is a credit. What I would like to suggest at this point, if you have your notes from the previous recording, would you be able to have them to hand just so you can have in front of you that dead click mnemonic that we looked at in our previous session. That will help us with our example, which we're going to have a look at in this session, and then we're going to answer this example in subsequent sessions thereafter. The idea of this example is to be able to take transactions, record the dual effect and the double entry, popping it into our ledger accounts in order for us to prepare our financial statements at the end of the period. So that would be our statement of comprehensive income and our statement of financial position. What we're going to do is have an introduction to this example in this first session. So let's have a look at this example. What we have here is George, and George commences business on the 1st of April 2009. The following transactions take place in his first 2 weeks of trading. So we can see then that we have 8 transactions for George in his first 2 weeks of trading, and we've got them listed out as you can see in your notes. Let's have a look at the first transaction. On the 1st of April 2009, he invests $50,000 into the business. Now we've seen a transaction similar to this in earlier sessions. What we need to do is be able to record the dual effect of this transaction and also to be able to record the debit and the credit entry. We're not going to do that right now. We're going to read through the rest of the example, but whilst I'm going through these transactions, have a think about that dual effect and see if you can think about that yourself. Our next transaction. On the 2nd of April 2009, he purchases $5,000 worth of goods on credit. So George is purchasing goods from another supplier and he's promising to pay for those goods at a later date. That's what we mean by purchasing on credit. Okay? We've been given an amount of time before we actually need to settle the bill. Okay, so the $5,000 that we would owe to our supplier. Our third transaction. On the 3rd of April 2009, he sells half of that inventory for $6,000 cash. So what we need to think about here is recording the sale of goods, the sale of inventory. Now remember, when we make a sale, we're going to be selling it for some sort of profit, and we can clearly see that we've made a profit here because he sold half of the inventory for $6,000, a lot more than when he purchased the full amount of inventory in the previous transaction for only $5,000. So we've made a sale, and in return for selling those goods, we're going to receive cash in return. The 4th of April then, the 4th of April 2009, he issues a cheque to pay for the goods that he received on credit. So now he is settling the amount that he owes to his supplier. He owed them $5,000. he is now settling that debt. He is settling the $5,000 by writing a check and giving it to his supplier. He's paying for those goods now. So we would need to think about the dual effect for paying for those goods that he purchased earlier on the 2nd of April. On the 5th of April, he pays his rent for April for $450 by cheque. So again, George has wrote a cheque and given it to the company that he rents his property from, we assume, and he's paying that rent by cheque. Okay, so we need to think about what the dual effect would be for paying for that rent. On the 6th of April 2009 then, he sells his remaining inventory for $6,000 on credit. So this time he's selling the remaining goods just like he did in the previous transactions, but this time he's not receiving cash in return straight away. He's receiving, he's making the sale, and in return he's letting the customer pay us later. So George is not receiving the cash now. He's going to let the customer pay at a later date. All right, so that's what we mean by selling on credit. On the 7th of April 2009, he purchases goods on credit for $7,000. So again, he's made a purchase on credit, so George is promising to pay that supplier at a later date for some more goods, so some more inventory. Our final transaction then, on the 8th of April 2009, he purchased a delivery van for $7,000 cash. Okay, so he's purchasing a delivery van, a motor vehicle, and he's paying cash in return for receiving that motor vehicle asset. So there's our 8 transactions in those 2 weeks for George. We need to be able to record those transactions. So now let's have a look at the requirement for this question. The requirement: for the first 2 weeks of trading, prepare the journal entries for George, and the journal essentially records that dual effect we were talking about. And by recording that dual effect, we can then record the debit and the credit entry as well. Our second requirement is to prepare the ledger accounts. Okay, so remember in our previous session we saw the ledger accounts, or T accounts that I referred to, and that's going to be where we record the journal entries, where we physically update the ledger accounts for that dual effect. Our third requirement will then be to prepare what is known as the trial balance. Now for now, what we will refer to the trial balance as is that it's just a list of our ledger account balances. Okay, so it is a list of ledger balances. And we'll look into that in a bit more detail when we come to prepare it later on. From our trial balance then, requirements 4 and 5, requirement 4 is that we should prepare a statement of comprehensive income for the 2 weeks ended the 14th of April 2009. And then we should prepare a statement of financial position as at the 14th of April 2009. So at the end of those 2 weeks. So how we're going to approach this then is for each subsequent requirement we're going to have a separate recording for it. In this session, what we're going to do now is record the journal entries, part 1 of the requirements, for that example called George. Now if you haven't seen the previous recording, you need to go back and refer to that example recording for George. So you should already have the transactions, those 8 transactions in April 2009, ready to go in front of you. Now what we can proceed to do is answer the question. Now, the first requirement said that we should prepare the journal entries for each transaction, recording that dual effect for George. So, what is our journal then? Well, a journal is a written instruction to the bookkeeper to update the ledger accounts. Okay, so a written instruction to the bookkeeper to update those accounts. And that's essentially what we're going to do. We're going to write down the dual effect for each transaction and then apply those debits and credits that we learnt with that dead click mnemonic. So let's have a look at the first transaction then. Remember, the first transaction was on the 1st of April 2009. And we said that George invests $50,000 of his own money into the business. Well, remember, George is the owner and he's investing his money into the business. Now, remember the business entity principle. We have to think about this from the business's point of view, not George's own personal point of view. So, the business would now then have $50,000 more cash as a result. Remember that cash, or cash at bank, is an asset. And what we are doing here is increasing the business's asset of cash at bank. So let's write that down. Increase in cash at bank, and I'll just put in brackets there an asset, $50,000. So an increase in cash at bank asset, $50,000. The business has more cash as a result of George putting that money into the business. Now that's one side of the transaction. What about the corresponding dual effect? Well, if the owner is investing money into the business, that is called capital. Okay? So what the business now has is an increase in capital. Okay? Now, capital, remember, that is an element in itself of the financial statement. So that's our capital invested. And again, that will be for $50,000. So just like you saw in previous sessions, increase bank asset, increase our capital as well. Fantastic. So there we go then. Now what we've got to do is show the debit and the corresponding credit. So this is where you need to look back in your notes where we talked about that dead click mnemonic. Go and have a look. Let's have a think about this increase at cash at bank. An increase at cash at bank is an increase in an asset. An increase in an asset must be, you all guessed it, it must be a debit entry. Increase asset is a debit entry, so I'm going to refer to that as DR. So next to cash at bank asset, I've wrote DR. I'm going to debit the cash at bank account. Okay, so that's the A in dead click. Now, every debit entry must have an equal and opposite credit entry. So, using that rule, an increase in capital must be a credit. But look back to your dead click mnemonic. On the credit side, on the right-hand side, at the bottom, an increase in capital is a credit entry. So that's what we'll do there. So CR, credit, an increase in capital, or the capital account. Okay, so there we are. That's our double entry, the debit and the credit recorded. And we will post those debits and credits to our main ledger, our ledger accounts, later on. But that is our first transaction dealt with. So for George then, let's now have a look at the second transaction. And remember, the second transaction for George, it says that he purchases $5,000 worth of goods on credit. So remember, George is promising to pay his supplier later. Well, if you've purchased goods, that would be a purchase of inventory. Now, purchases appear in your statement of comprehensive income. They essentially reduce your profit. Okay? Purchases is an expense. So if you're purchasing goods to then resell to customers and make a sale out of, a purchase of good is known as purchases and therefore is an expense. So, to record this transaction then, the dual effect, we're going to increase purchases, and purchases is an expense, and that will be with the amount of $5,000. Okay, that's the value of the goods that we purchased. So we're going to open up another account, call it purchases, and increase that expense account with $5,000. Remember, the dual effect. We've got to have the equal and opposite effect of that transaction. Well, it can't be cash because we're not paying for those goods now for cash. So it's not going to be a decrease in the cash asset. Now, because we're purchasing goods from a supplier, and that supplier we probably usually do a lot of trade with, we would probably call that a payable. Okay. Now, a payable is someone who we owe money to, so suppliers who we owe money to. If you remember from earlier sessions, we said that a payable was a current liability. And that's what we need to recognise now. We owe money to the supplier, it is a liability, and we're going to call that a payable. So, we are going to increase our payables liability with the same amount that we just recognised that we owe to our supplier of $5,000. So we're increasing our expense of purchases and also increasing our payables liability as well. There we go. So that's the dual effect recorded. Now what we need to do is show the debit and the credit entry. Again, look back to your dead click mnemonic we discussed in earlier sessions. Now we're increasing a purchases expense. So you can see expenses are the E in that dead click mnemonic. An increase in an expense, what would that be? Debit or credit? I'm sure you're all saying at home, Natasha, it's a debit, so we'll go with that. It is indeed a debit entry. Increase, expense, debit entry. Which means, of course, then that the increase in the payables liability must be a credit. But again, look back at your mnemonic. An increase in a liability must be a credit. So always use that mnemonic to help you. And it's something essentially that you have to remember in order to be successful in this exam. Let's have a look at transaction number 3 then. And in transaction number 3, we were told that he sells half of that inventory for $6,000 cash. So we're selling the goods in return for cash. So, of course, we must have an increase in our cash at bank. And remember, cash at bank is an example of an asset. $6,000 would be that amount there. So, selling the goods, receiving cash in return. Now think about that word that I just mentioned. selling. We are selling goods in order to make a profit, because in this syllabus we'll be looking at commercial profit-making businesses a lot of the time. So what we need to do is record the fact that we've generated some income, sales income. So what we're going to do is increase sales. So we're opening up a new account called sales, which is an example of income. Remember that income go into your statement of comprehensive income to help you work out the business's profit or indeed loss for the year. And that would be for the same amount, $6,000. Again, we've recorded the dual effect. Now let's apply the debits and credits to it. An increase in an asset of cash at bank. What do you think? A debit or a credit entry? Well, you must be right. It has to be a debit entry. So DR, increase in an asset, is a debit entry in the same way that the first transaction was as well. Now let's have a look at the increase in sales. Obviously we know it has to be a credit because every debit must equal a credit. But why? Well, let's look at that dead click mnemonic. On the credit side, income. If we're increasing income, credit. Okay, so an increase in income must be a credit entry from our dead click mnemonic. There we go. So that's our credit entry. And that would be our third transaction, the sale now complete. So then let's carry on. Let's proceed on to the fourth transaction. And this fourth transaction says that he issues a check to pay for the goods he received on credit. So now George is settling that amount, that payable, that he owed to his supplier. So let's have a think about this then. If we are settling an amount that we owe to our supplier, we are effectively reducing our liability. So our first effect will be to reduce our payables liability. And that would be for the amount that we received the goods for. And we said back in transaction number 2 that that was $5,000. So if you're paying it, you're settling it, you do not owe that money to the payable anymore. So you wipe it clean and reduce that liability down. How are you going to reduce it down? Well, you're going to pay cash for it, aren't you? You're going to give that supplier cash to clear that amount that you owe to them. So we're going to decrease cash at bank, remembering that that's an asset, with that $5,000. Dual effect done. Now let's apply the debit and the credit. A reduction in a liability. Now this is the first time we've seen a reduction. And remember that dead click mnemonic, we said that for increases in assets, liabilities, income, expenses, capital and drawings, that dead click would always apply. What about though if we decrease? Well, if we decrease any of those types of accounts, essentially dead click would be reversed. Now if you're increasing an asset of cash at bank, for example, that would be a debit entry. But if you are now decreasing your asset of cash at bank, well, that would be the credit entry. Okay, so the opposite. Remember, debits and credits are opposite. And look, you know, we've seen that here now. That reduction at cash at bank must be a credit, the opposite to an increase. Which means then that reduction of the liability of payables must be a debit. An increase in a liability is a credit, a reduction in a liability, well, that must be a debit. So if it decreases in the account, dead click is reversed. So then, that's the 4th of April transaction now complete. Let's continue on. On the 5th of April 2009, he pays his rent for $450 by cheque. So let's have a think about what we're doing there. Now, if you're paying rent, rent is essentially a business expense. You need to incur that expense in order to run your business. Now, just like purchases was a type of expense, rent would be a separate category of expense away from purchases. So we're going to have an increase in the rent account, which would be an expense. And that would be for $450. Now, how are you paying for that rent? Well, you're paying for it by cheque. Well, what you need to do then is to decrease your asset of cash at bank. So decreasing your asset of that cash at bank. Okay, so dual effect settled again. You're paying for an expense in cash, increase the expense, decrease the cash asset. Dual effect then, increasing rent expense. Look at your dead click mnemonic. Increase expense must be a debit. That's the E in dead click. So we're going to debit the rent expense account with that increase in an expense, which means, of course, again, we're going to credit and reduce the cash at bank asset. Next transaction then, on the 6th of April 2009, he sells his remaining inventory for $6,000 on credit. So again, George has made a sale, but not for cash this time. This time it is on credit. So we're selling goods to the customer, and we're saying to the customer, you can pay us later. Now essentially that customer owes us money. That's a good thing. As a result, what we would need to do is recognise an asset. Okay? That asset will be known as a receivable. Customers who owe us money. So we're going to increase our receivables asset by the amount that we've sold the goods for, which was $6,000. Okay, so we're increasing our receivables to recognise the fact that we are owed money and will receive cash in the future when that customer then pays us. We're still making a sale though, so we're still going to increase our sales account, which remember is a type of income account, and again that will be for the same amount, $6,000. The dual effect would still balance, still work. Debits and credits then. To increase an asset, increase asset must be a debit entry. It's the A in dead click. So to increase an asset, that would be a debit entry. Which means then that the increase in sales must be the corresponding credit entry. Okay, so that's our 6th transaction dealt with. Nearly there, only 2 left to do. Let's have a look at transaction number 7. Now transaction number 7 states he purchased goods on credit for $7,000. So again, this is another transaction with the supplier to purchase goods, and again we are promising to pay later. So what we need to do then, if we are purchasing goods for resale, we're going to increase our purchases expense account with the value of the goods of $7,000. So increased purchases expense because we're purchasing goods for resale. Now we're purchasing these goods again on credit, so what we need to do is recognise a payable. So we're going to increase our payables. What type of account is a payable? Have a think. It's going to be a liability. The liability be $7,000. Again, the dual effect works. Now what we need to do is do the debit and credit. Looking at purchases first of all. An increase in our purchases expense. What do you think? Debit or credit? I'm sure you've all seen this. We did do this same transaction on the previous one. We did that in transaction number 2. That would indeed be a debit entry. An increase in payables liability then, well, that has to be, of course, the credit entry. Every debit must have an equal and opposite credit. Okay, so our final example then, our final transaction for George that we need to do the journal for. Well, we can see then that he purchases a delivery van for $7,000 cash. So how are we going to record the dual effect? Well, what's happened is he has purchased a motor vehicle. Remember, that's an asset, so the motor vehicle being the delivery van. And the business has now got that asset in its business. So the first side of the dual effect is we're going to increase our motor vehicles account. It's a different type of asset. And we're going to increase that account by, again, $7,000. Okay, so the business now has that asset. We're going to increase that asset account up. Remember, for each different type of asset, liability, income, expense and capital, we need to have a separate account for each different type of asset, liability, etc. Now, as a result of receiving that motor vehicle, we've paid out cash. So, again, what we're going to do is reduce our cash at bank asset, and we're going to do that by $7,000. Again, so the dual effect indeed works. So, that's the transaction and the dual effect recorded. Now let's do the double entry. So, to increase our motor vehicles asset account, increase an asset, well, an asset is the A in that dead click mnemonic, that would be the debit entry. Okay, so DR, debit for the motor vehicles asset account. Which means then that our reduction in the cash at bank account, that would be the credit entry, and that would be the debit and credits dual effect now recorded. So that's it then. We've done our 8 transactions. We've wrote the journal for those transactions, recording that dual effect. We're given that instruction to the bookkeeper. Now what we need to do is prepare the ledger accounts. Continuing on with our example then for George, we've done in the previous session looking at the journal and recording the double entry and the dual effect for George. What we now need to do is record these transactions in the ledger accounts. Now what we're going to do is record them in the main ledger. Now the main ledger sometimes can be referred to as the general ledger or sometimes referred to as the nominal ledger. But we'll use the terminology main ledger as that is most commonly referred to in the exam. So what we can see then in our notes is now what we have is we have a set of blank T accounts or ledger accounts. So you can see there that you've just got the bare bones of the account, the T. What we have to do is have a ledger account or a T account for every different type of asset, liability, income, expense and capital. So if we refer back to the journals that we just did for George, we can see then that our first journal was on the 4th of April, where we said we were going to debit cash at bank account and credit the capital account. What we've done there is we've created two accounts, cash at bank and capital, and they needed a separate ledger account each. The cash at bank account appears in the statement of financial position along with assets, liabilities and capital. So what I'm going to do at this point is remind myself that the financial statement it's going to get put into is the statement of financial position. And remember, when I talk about a statement of financial position, I abbreviate it to SFP. Now, along with the name of the account at the top, we also need to state the debit and the credit side. Remember, debit on the left, credit on the right. So, on the left-hand side at the top of the account, we put DR, debit, and then on the right-hand side, we're going to put CR, credit. So debit and credit, drive on the left, crash on the right. Now we said that the other account we had was capital. So you can see in your notes that the second blank ledger account, well, we're going to use that for capital. And remember, capital is an item that appears in the statement of financial position. So again, I'm going to remind myself that ultimately the balance of this account will go to the SFP, the statement of financial position. Don't forget, we also need to write in DR for debit on the left and CR for credit on the right. Now we have those accounts written in, let's proceed to pop that journal transaction into those ledger accounts. So we have three columns on each side of the ledger account: the date, the narrative and the amount in dollars. So for our cash at bank account, let's write those headings in: date, narrative, and then the amount in dollars. So three columns. That's just on the debit side. We now also need to do the credit side with those same three columns, and we shall head them up: date, the narrative, and the amount in dollars. So let's post transaction number one, the journal, into those ledger accounts. We said we were going to debit cash at bank with $50,000. So on the debit side, the left-hand side, the date, 1st of April 2009. The narrative will always be the name of the opposite account that you're posting. Now we're debiting cash at bank account, the corresponding credit entry, well, that's going to capital. So the narrative will be the capital account. Okay, so we're posting the opposite credit entry to capital, but we're writing that in there just so the bookkeeper can trace the double entry to make sure it all works. The amount we said was $50,000, and that's what we're going to pop under the amount, the dollar sign. That is it. The debit entry is posted. So essentially one side of your journal is now complete. And if you wouldn't mind, if you go back to your journal, what I like to do to keep a track of the transactions that I've posted to ledger accounts, I always like to give a little tick next to that transaction to show that I've posted it. I want to do it for this one, but you can do the rest yourself as you're following along. Now we need to post a credit to the capital account. So $50,000 I'm going to tick off, and I'm going to post that journal to my capital account. So if we go to our capital account, I'm not going to write the headings again because you can see the headings. It's not necessary as long as you're posting those 3 bits of detail in. So on the credit side of the capital account, we're going to pop the date, the 1st of April 2009. We're going to post the name of the opposite account where the debit entry is going to, which was the cash at bank account. Now, because I don't have a lot of space, I'm just going to write bank there. But that is obviously the cash at bank account where the corresponding entry has been posted. Now, let's put in the amount, $50,000. Okay. The debit's been posted to the cash at bank account, and the credit's been posted to the capital account. Okay. So essentially the hard work has already been done in the journal, you know, deciding what is a debit and what is a credit. The physical posting of it, well, with a bit of practice, it should be fairly okay to have a go at. Let's proceed to do the rest. So with transaction number 2 in our journal, we said that we were going to debit purchases and credit our payables liability. 2 new accounts. Therefore, for each account, we need to open up a ledger account for it. So let's do that then. Moving on then to another blank ledger account. Name of the account, we're going to do purchases. And we're going to have a debit and a credit side. Remember we said purchases was an expense. Now which financial statement does an expense go to? That's right, you guessed it, the statement of comprehensive income. You remember I abbreviate the statement of comprehensive income to SOCI. S-O-C-I, SOCI. Okay. That's going to be useful when we prepare our financial statements later on. So, our other account was payables, so we're going to do the same again. Debit on the left, credit on the right, and then we're going to open up an account called payables. And in that account, remember that payables is a liability, and a liability goes into the statement of financial position, shortened to SFP. So we're going to write that in as little reminders to ourselves for later. Right, now we've opened the accounts, let's post the journals. We said it was on the 2nd of April and we're going to debit purchases account with $5,000. So the date, 2nd of the 4th, 2009. The narrative, we said that that was going to be the name of the opposite account, which is payables. Remember, that's where the corresponding credit will go. And then the amount, $5,000. Okay, so we've posted the debit entry to purchases, increased that expense account up. Now let's have a go at payables. So moving down to payables then. Credit payables, again with that $5,000. So, on the 2nd of April, 2009, our opposite account we said was going to be purchases, because that's where the debit entry went. And again with the amount of $5,000. So journal number 3 then, what we said we were going to do is debit cash at bank and credit sales because we made a sale in cash for those goods. So I'm going to tick off my journal transactions and then I'm going to post them to my ledger accounts. Now we already have a cash at bank account that we are now again debiting. So we need to go back up to our cash at bank account. Note that we have our first transaction already in there. We're just going to add to that now. So with my third transaction on the 3rd of April 09, I'm going to debit my cash at bank account with $6,000. And remember the name of the opposite account, we said the credit was going to sales. So the narrative would be sales. There we go. So hopefully you're starting to get the hang of what we're doing here at home. So we've done our debit to cash at bank. We don't have a sales account though yet for our income, for our sale. So we need somewhere to post that credit entry. We're going to need to open a sales account. So new account. Okay, so new ledger account. We're going to call this sales. Debit on the left and the credit on the right. Now, we also need to establish the financial statement. Sales is income. Income gets reported in the statement of comprehensive income. Remember, abbreviated to the SOCI. Okay, so I'm just reminding myself there. Let's post a credit entry. 3rd of April 2009. The corresponding debit went to cash at bank. We'll just call it bank for lack of space. And what we'll do is we'll post the amount there, which we said was $6,000. So again, there we go, 3rd transaction posted. Our 4th journal transaction. Well, with this one, we said that we were paying off our liability, paying our supplier and paying off that payable. We said we were going to debit payables and reduce down that liability, and then credit cash at bank to reduce down our asset. Well, we already have a cash at bank account and a payables account, so no new accounts need to be opened up in order to post this transaction. So let's go back to our payables account, and we said with our payables account that we were going to debit it with 5,000. So we're going to look at the date, 4th of April 09 on the debit side. Our corresponding account will be cash at bank, and that's going to be with the amount that we're settling, $5,000. Can you all see then that the debit side of payables and the credit side of payables, they both have $5,000 on them. They both balance. At that moment in time, that suggests to me, looking at this ledger account, that there is nothing owed to any payable liabilities. Excellent. So we've debited payables. That account has now effectively been cleared. Now let's do the credit to cash at bank. And we said with cash at bank on the 4th of April 09, our narrative will be payables with our amount, which we said was, again, 5,000. So there we go. Transaction number 4, done. We're halfway there. Let's do the rest. Going back to our journal. Transaction number 5 then. We said what we were going to do with that is debit our rent expense account and credit our cash at bank account to be paid an expense by cheque. So again, make sure you tick off those amounts. 450, we're going to post them to the ledger. And going back to our ledger accounts, our debit entry will go to the rent expense account. We haven't opened that account up yet, so let's do it now. So just after our sales account, we're going to open up a new T account called Rent. And again, just noting the debit and the credit entry. Rent then, remember, is an expense. An expense gets recorded in the statement of comprehensive income. So again, we'll just write SOCI there to abbreviate that down. Let's post the double entry then. Our debit entry, we said, was for rent expense. So the date, the 5th of April 09. Our opposite account is the bank account, and $450 is the amount posted on the debit side of the expense account. Let's do the credit to cash at bank. That was our first account that we opened up. So in this account then, on the credit side, to reduce down that asset, 5th of the 4th, 09, opposite account is the rent expense account, and 450 is a credit entry for that. Okay, so hopefully you're getting a feel for this now. Let's do the 6th transaction. Transaction number 6, then, we said we were going to debit receivables assets by $6,000 and credit sales income with $6,000 as well. Remember, receivables is an asset because we sold those goods on credit. A customer is paying us later. Okay, so we've done session and transaction number 6. Now let's have a look at transaction number 7. Looking back at the journal, we can see then that what we said we were going to do is debit purchases and increase that expense by $7,000 and credit payables, the liability, by the same amount of $7,000. Both of those accounts are already opened up. It's the same transaction as transaction number 2, so all we need to do is post it in the same places. So ticking them off then, if we go back to our purchases and payables ledgers, we can see then that with purchases on the 7th of April 09, the corresponding account is payables, 7,000 on the debit side to increase that expense. Now if we do the corresponding credit entry, looking at payables on the 7th of April 09, our opposite account is purchases, and we're going to credit that with 7,000. And there we go, transaction 7 complete. So our final transaction then, our final push. Okay, what we need to do now is record transaction number 8, and with transaction number 8, remember we purchased that delivery van for $7,000 cash. We said that we were going to debit motor vehicles assets with $7,000 and then credit cash at bank with that same amount of $7,000. So we're going to tick those two amounts off. And now we're going to go back to our main ledger, and we're going to need to open up the motor vehicles asset account first of all. And this will be our last account that we need to do. So just under the receivables asset account, debit on the left, credit on the right, motor vehicles, as I've already mentioned, is an asset. An asset appears in the statement of financial position. And we're going to debit that account with that 7,000. 8th of April 09. Our opposite account is cash at bank. $7,000 is what we would debit that account. Now let's go back and do the credit entry. Remember, we said that was going to cash at bank, our first ledger account. So on the credit side, 8th of April 2009, our narrative will be motor vehicles, and our amount, $7,000. And there you have it. We've completed the ledger accounts from the journals. Remember, the journal is a written instruction to the bookkeeper to update the ledgers. Well, that's what we've done. We've updated the ledger, the main ledger. In our last session, what we saw was posting our journal entries into our main ledger. And really what we've done there is recorded the full double entry into our ledger accounts. Now at the minute, if you look at your ledger accounts from this example called George, you will see that actually these ledger accounts don't tell you an awful lot. Essentially it's just a list of numbers on either the debit or the credit side, or both of some of these accounts. So what we need to do at each period end, which is usually the month end, but in this case it will be the 2 weeks ended, what we need to do is now close off the ledger accounts and balance those ledger accounts to give us more information to help us prepare those financial statements. Remember, our ultimate goal is to prepare the financial statements, the statement of financial position and the statement of comprehensive income. So, looking at the main ledger now that we've just completed for George, now what we need to do is balance the accounts. And for this you're going to need a ruler, okay, because we like things to be nice, neat and presentable. Okay, so what we need to do is get a ruler. Now you can see then, let's start with the cash at bank account. We can see that there's transactions on both the debit and the credit side. Now the whole concept of balancing the accounts is the clues in the name. They should be equal. Both the debit and the credit side of every single ledger account must be equal, the same. Which means in a lot of cases you're going to have to force it to be the same to do a closing balance or a balance carried forward into the next accounting period. So what we're going to do first, have a look at the cash at bank account. And we can see that the debit side looks quite a lot higher than the credit side. If you're not entirely sure just at first glance, what you can do is you can make a little note. So you can say, what is the total of the debit side? What is the total of the credit side? And what is the difference? What would be the balancing figure? Well, for cash at bank then, the debit side, we can see that it was 50,000 plus 6,000. So $56,000 is the total of the debit side of the cash at bank account. If we then compare that to the total of the credit side, well, you need to get your calculators ready, or you can do it in your head, whatever. We can see that 5,000 plus 450 plus 7,000, well, of course, that's going to give us 12,450. So, adding those three totals down, that would be the credit side total. There's quite a big difference between the two. Now, if we take the difference, that's going to be our balance, okay, the balance of these accounts. So just run that through your calculator, then what we should get is 43 550 as the difference between the debit and the credit side of the cash at bank account. And essentially that's the balancing figure we need to force both the debit and the credit side to be equal. Now you're always going to insert that balance on the lower side. Now clearly that would be the credit side in this case. So let's insert that balancing figure to force our cash at bank ledger account to indeed balance. So what we need to do then is this is going to be on the last day of the period, the accounting period. Now remember, for George we're doing this for 2 weeks, so this would be on the last day of the 2 weeks, which would be the 14th of April. So on the credit side then, 14th of April 2009, we're going to insert our balancing figure, but we need to give it a name. Well, this is essentially our closing balance, what I refer to as a balance carried forward. Okay, so the narrative will be balance carried forward, or C/F. Sometimes you see it referred to as balance carried down. That's fine, means the same thing. So balance C/F is balance carried forward, and we're going to insert that balancing figure of 43,550 onto that lower side, being the credit side. Now, because you've inserted that balancing figure, both the total of the debit and the credit side would be equal. So at this point then, with your rulers, you need to rule off a total. So we're going to total the debit and the credit side, the debit and the credit side, and they're both going to total $56,000. And that's our account balanced and essentially closed at the end of those 2 weeks. Now, because the balance is closed, doesn't mean that the bank account just vanishes and goes nowhere. You know, in the next day, the 15th of April, George is still going to have some cash at the bank. You can clearly see that he invested $50,000 and he generated $6,000 cash from sales, but only spent $12,450 of it. There's still money left in George's bank account, and we need to recognise that fact at the start of the next accounting period. In this case, the 15th of April, the start of the next accounting period. Now what we're going to have then is an opening balance, which, as you can recognise, would be the opposite to the closing balance. Now with an opening balance, we're going to call this balance brought forward. Okay? And the balance brought forward, or opening balance, will be on the opposite side to where the closing balance was popped in. So, in our cash at bank account, underneath the totals, 15th of April 09, balance B/F, or brought forward, well, that's going to be the same amount as the balance carried forward. So that 43,550, in it goes. Underneath the totals that we just drew. Now generally, cash at bank account will be the largest account, so you can see there that obviously that account is quite full at the end of the period. What we're saying is though that George has an opening asset at the bank at the start of the next accounting period. He has $43,550 left, and he can spend that however he wants in the next accounting period because he has that balance there. Notice that the opening balance is on the debit side. That would tell you that that is an opening asset. So any opening balances, if it's an opening balance on an asset account, that idea of dead click will always apply. An asset is under the D of dead click, which represents debit. So a debit opening balance on an asset account, well, that means it's an opening asset. He has cash at bank. But what would happen if his opening balance was on the credit side? Have a think about that. What if his opening balance was on the credit side? Well, surely that would mean that he spent more out of his bank account than what he physically had coming in as cash, which would mean that he would have been overdrawn at the bank. And if you're overdrawn at the bank, that means you've obviously spent more money than what you've got coming in, and you owe that money to the bank. So if this opening balance was on the opposite side, that would indicate to us that in reality we don't have an asset of cash at bank. We are actually overdrawn at the bank, and we owe that money back to the bank. Okay? Which would mean that that opening balance on the credit side would represent a liability. Now, bank account is one of the unique accounts where the opening balance could either be a debit, like it is here, or a credit if the business is overdrawn. The other accounts, dead click normally applies to opening balances. Okay, generally they'll be on the same side as what we looked at with that dead click mnemonic. Let me illustrate that to you with this next account, the capital account. So we can see then that the capital account is fairly straightforward. We only have a $50,000 credit entry sat there, so we can clearly see that the credit side is indeed higher than the debit side. Once you've done a bit of practice on this, there really is no need to go back and do the little list of the totals. You just identify the higher side and get the lower side to equal that. And we can do that here. Our balancing figure will be on the debit side, the lower side, for 50,000. So, on the 14th of April, 09, balance carried forward, our closing balance is 50,000. Notice both sides are equal. So when we do our totals, well, because we can clearly see that they're both 50,000, what we can do is just simply double underline it to say that that account is closed. You could do a total like we did with the cash at bank, but really all you're doing is writing 50,000 in twice again, which, it isn't necessary. We can clearly see that the balance is 50,000. So we're closing the balance on the debit side, which means we need to open the balance for the next accounting period on the opposite side, which would be the credit side. So, 15th of April 09, balance brought forward, our opening balance at the start of the next accounting period, $50,000. And there you go. If you only have one transaction, accounts are a lot simpler to balance in that respect. Okay. So, what I want you to do now is have a go at balancing the remainder of the ledger accounts and see how you get on and see what your closing and opening balances will be. I would like you to pause the recording now whilst you are doing that, and then resume the recording once you have completed balancing all the ledger accounts all the way through to the motor vehicles account. All right, off you go. Okay, let's see how you got on then. So we did the cash at bank and the capital account with you. Now what we need to do is have a look at the answers to the rest. So for purchases then, hopefully you've got an opening balance brought forward of $12,000. Now remember, that's an expense, and an expense, if you're increasing it, is a debit entry. So can you see then that that $12,000 is indeed on the debit side? We then have a look at payables then. Your closing balance and your opening balance should be $7,000. With your opening balance brought forward on the credit side, that is again for $7,000. Notice then that payables is a liability, and we have an opening liability on the credit side for that $7,000. That means that George owes that supplier $7,000 starting on the 15th of April. So that balance is still outstanding. That's what we are showing here with our ledger account. Moving on then, let's have a look at sales. Sales, we should have got an opening balance brought forward of $12,000 on the credit side. And remember, sales is income, so that balance brought forward on the credit side is right, because income is the I in dead click, and that appears under the credit. Looking at rent, rent is an expense just like purchases. We have an opening expense of $450 on the debit side. Finally then, our receivables is an asset. We can see that our receivables asset is $6,000 on the debit side. And remember, that's an opening asset. So the business is still owed that money at the start of the next accounting period. Then we have a look at motor vehicles. And again, motor vehicles is an asset of $7,000 on the debit side, showing that we still have that motor vehicle of $7,000 in the business at the start of the next 2 weeks. So there we go, that's balancing ledger accounts now complete. So now we shall have a look at our third requirement in George, which will be the trial balance. Continuing on with our example George then, in the last session we posted and balanced all the accounts. So we posted the transactions to the main ledger, and then in that very last session that we just did, we balanced off those ledger accounts. Now what we need to do is use those balances and bring them into our trial balance. Now a trial balance is a list of brought forward balances from your ledger accounts. So let's write that down. The trial balance is a list of brought forward balances. Okay, and those brought forward balances come from our ledger accounts. So you should still have your ledger accounts handy, and you've now balanced them all up from our last recording. Now we're going to have a look at this trial balance. Now this trial balance is still an internal document. This is still something that we do not publish to our external users. The main reason why we do this trial balance is to really look and detect errors and spot those errors if we can see any in our ledger accounts. So really, this is the final check before we then post to our financial statements. This is really very straightforward. What we have in the trial balance is we have the account name that has come from each of our main ledger accounts. We've got the financial statement that that account relates to, so the statement of financial position or the statement of comprehensive income. And then we have two columns to show the figures. One column, which is the debit column, DR, and the second column being the credit column, CR. And these are going to list all those brought forward balances, those amounts, and we're going to extract them from the ledger accounts. So you can see in your notes then we have all the account names that we've opened up already sat on our trial balance. What we need to do is bring in the figures from our main ledger. Let's take a look at our first main ledger account. We said that was cash at bank. And notice that we had a brought forward balance brought down on the debit side of the cash at bank account of $43,550. Debit side, we've got the amount. We also know that that's being posted to our statement of financial position, one of our financial statements. Okay, let's start to complete our trial balance. So for the cash at bank or bank account, the financial statement is the SFP, the statement of financial position, and the amount was $43,550, and we're going to list that on the debit column. Okay, so underneath the debit column. And that's pretty much it with the trial balance. Now we need to do the remaining accounts and post them as well. So going back to our main ledger, our next account was the capital account. And the capital account was $50,000 balance brought forward on the credit side. And again, we already know that that's an SFP account. So let's proceed. In our trial balance, next to capital, the account name, it goes into the statement of financial position, SFP, and that's going on the credit side of $50,000. Okay, and we'll proceed and continue on. Our next account was purchases. So if we pull that up, our purchases account, we can see that it was $12,000 balance brought forward on the debit side, and that is coming and going into, should I say, our statement of comprehensive income. It's an expense, remember. So let's do that. Purchases, financial statement is the SOCI, statement of comprehensive income, and we said that that was a $12,000 debit transaction. Next one then, is our trade payables, or payables as we called it. Going back to our main ledger, payables, we can see that we have a $7,000 credit balance brought forward in the ledger, and that is in our statement of financial position. That's where it will ultimately end up. So trade payables, an SFP figure, $7,000 on the credit side. Going back to our main ledger, our next account is sales. Sales, we had a balance brought forward of $12,000 on the credit side, and that is ultimately going to be posted to our statement of comprehensive income. So in our trial balance, statement of comprehensive income, $12,000 credit. And again, hopefully when you're at home and you're seeing this, you will appreciate that you might be going a little bit faster than this now, because hopefully you've pretty much got the idea of what we're doing here. Okay, so main ledger, let's go for rent this time. Our next account, $450 balance brought forward on the debit side this time. And again, it's a statement of comprehensive income item. So, financial statement, SOCI, $450 in the debit column this time. Okay, next account then, trade receivables. Trade receivables, $6,000 balance brought forward on the debit side, and that is a statement of financial position item. Remember, it's an asset. In our trial balance, trade receivables goes to our SFP, $6,000 would go into the debit column. Finally then, we have motor vehicles, going to our main ledger. Motor vehicles, $7,000 debit, and again, that's an SFP item. Posting that to our trial balance, financial statement SFP, $7,000 debit. And there you have it. Every account, the balance brought forward, list it in your trial balance. Now you should be able to balance this trial balance and have both the debit and the credit column be equal. If that's the case, that's a pretty good indicator that you've done everything correctly. So let's just double check that then. Our debit column, we start with 43,550 plus 12,000 plus 450 plus 6,000 plus 7,000. Well, that should give us 69,000, the total of the debit column. Let's check the credit column. 50,000 plus 7,000 plus 12,000. Look at that. The total of the credit column equals 69,000. And you notice I have a little smile because if your trial balance balances, you pretty much know you've done everything just about correct. Now, the trial balance is probably one of the best indicators to check for errors, to see if there's anything wrong. Because if those two columns don't balance, well, you've done something wrong in your ledger accounts. We'll have a session later on in the course where we look at errors and using the trial balance to detect errors. But for now, it balances, so we won't worry about it. Everything must be okay. Now, this isn't the final thing that we need to do before our financial statements. At this point, we need to do one final journal. And this final journal is all to do with inventory. Now, we're going to deal with now the idea of closing inventory or ending inventory. Closing inventory is all the stock left in the business at the end of the accounting period that hasn't yet been sold to external customers. Now, remember how we said in the statement of financial position, inventory is a current asset. Remember we said that a few sessions ago. What we need to do is be able to value that asset and show how much inventory is left in the business that we can sell in the next accounting period and generate cash from. Remember, inventory is what we own. Now, when we've dealt with inventory transactions, we've either posted them to purchases if we've bought them or sales if we sold them. This is focusing on the idea of the asset at the end of the period. So, first thing we need to do is find the valuation of our inventory that's left over at the end of the accounting period. At this point, it might be helpful for you to pull up the original question, George, and look at those 8 transactions once more. And look at what transactions involve inventory. Okay, so have a quick look at that. Maybe pause your recording whilst you're having a brief look at all the transactions that involved inventory. Okay, so essentially there's 4 transactions in this question of George that involve inventory or goods. The first transaction was on the 2nd of April 2009, where George purchased goods on credit. And he purchased those goods for $5,000. He brought that inventory into the business. We're putting it in at the cost or its original cost to the business. That would increase the inventory value. We want the inventory value at the end of the period, so the 14th of April. So our next transaction that involved inventory, well, that was the transaction immediately after, on the 3rd of April. And that transaction involved a sale of half of those goods, or half of that inventory. Now, if you're putting inventory in at its original cost, then you need to remove it out at its original cost. Okay? So you're not removing $6,000 out, which is the value of the sale. All we're saying there is that, well, if we've sold it for $6,000, we must have made a profit because we only bought it in for $5,000. So if you're putting it in at its original cost, you need to take it out because the difference between the cost and what you sold it for, well, obviously that's the profit. So what we're going to do is remove inventory, half of that inventory in this transaction, so half of the original cost, which should obviously be 2,500. I'm putting it in brackets to take it away. At that point then, George only has half of his stock left at an original cost of $2,500. Hopefully you've noticed then that the next transaction after that was again another sale, and that was the sale of his remaining inventory on the 6th of April. And that would be the other half of the inventory because it says the remaining amount. So if that's the case, then that must be the other half of the inventory with the remaining cost of 2,500. At this point, there's no inventory left. All the inventory that's been purchased has indeed now been sold up to the 6th of April. But remember then, we had one more transaction, and you should be able to see on the 7th of April, he purchased more goods on credit for $7,000. He's brought $7,000 worth of inventory into his business. Okay, $7,000. So that's going to increase our inventory balance back up. So at that point then, we have that inventory in stock. The final transaction on the 8th of April was all to do with a delivery van, which is not inventory. So that must be it. The 14th of April, our year end, our closing inventory balance must be the $7,000 worth of goods remaining at the year end. Now we are going to look at inventory in a bit more detail in later sessions, and actually it'll be one of our next sessions in Chapter 4. In the meantime though, we have our inventory valuation. Everything that goes in at cost has got to come out at cost. Now, the final thing that we need to do then is say, well, where does inventory fit in the financial statements? Well, as I've already mentioned, inventory is an asset. It's a current asset. That asset is available for sale in the next accounting period. But there has to be a double entry. Remember, this is a journal where the double entry gets posted. So, the physical journal itself. Well, we have an asset of inventory. So we're going to increase inventory asset. Remember, an asset appears on the statement of financial position with that $7,000 valuation. Now, increase in an asset, a debit or a credit entry. Hopefully you're all saying debit, based on what we learnt in previous sessions. It is indeed a debit entry. And obviously, we're going to have a corresponding credit entry. Now, as I explained when we looked at the statement of comprehensive income in detail in earlier sessions, we need to see closing inventory not only as an asset, but also as a reduction in our cost of sales in our statement of comprehensive income. Let's write that down. Okay. So what we're going to do is decrease cost of sales. And cost of sales is essentially all your expenses or costs to make what you sold. And to reduce cost of sales in the statement of comprehensive income, so just write there SOCI, we're going to do that with the inventory valuation of $7,000. Sometimes you see this referred to as a credit to closing inventory in the statement of comprehensive income, but it means the same thing. To reduce an expense or a group of expenses, as we'll see with cost of sales, that is going to be a credit entry. Remember, increase in expenses a debit, the E and D click, we're going to reduce it down. Now the reason why we're showing it here is because when we have purchases in the statement of comprehensive income, purchases is going to be for the full amount of inventory that we purchased in the period. If you remember from our trial balance, our purchases expense was $12,000. But we didn't sell all the goods that we purchased in the year. Now, we have to think about this principle of matching or accruals, again, as we saw earlier on. We must match everything that we earn to everything that we incur. We must match our sales income to the cost of generating that income. Well, the cost is going to be based on only the goods that have been sold. And we can see in this list that we've only sold $5,000 worth of goods at its original cost. So in order to get a true profit for that accounting period, we need to remove that $7,000 closing inventory from cost of sales, which is where purchases will appear as well, in order to be able to show a true gross profit in the statement of comprehensive income. So it's all about matching, which we discussed, like I say, earlier on. We have got a dedicated session devoted to inventory. We'll leave it there for now and we'll proceed to prepare the financial statements, and we'll see how this journal works in action in our next session. Continuing on with our George example then, we're on the final hurdle now. We've done all our internal documentation, we've prepared the ledgers, we've done the journal. We have just completed the trial balance and the closing inventory journal as well. The final thing to do is prepare our accounts suitable for publishing to those external users who are going to look at our financial statements. Our first financial statement that we're going to prepare based on our George example is going to be the statement of comprehensive income. And in your notes, you should have a pro forma that we can now complete. So, with the statement of comprehensive income, remember it's always for the period ended. Remember, it's a moving picture of income and expenses for that accounting period. So, we start with our income then. And our income would be our sales revenue. So, sales is always at the top. Look back to your trial balance and find sales. You'll see that sales is $12,000 on the credit side of the trial balance. So tick that off, if you will, and then we're going to take that $12,000 and pop it into the end column of the statement of comprehensive income. Now these two columns don't represent debit and credit here. They simply have a subtotal column on the left and a total column on the right. And because there's no adjustments needed to sales revenue, we can pop that straight into the total column. Now, we have to match that sales revenue or income against the cost incurred in order to generate that sales income. And that is described as cost of sales. So less cost of sales. And that's a heading. Now, cost of sales is made up of three main components: opening inventory plus purchases minus closing inventory. Now, we'll start off with opening inventory. This is inventory already in the warehouse or on the premises of the business at the start of the accounting period. Well, the start of the accounting period for George was the 1st of April 2009. However, that was the same date as he started the business. So, if he's just opened up his business, he wouldn't have any opening stock or opening inventory already there. So in the subtotal column, opening inventory will be 0. What we're then going to do is add to that our purchases expense. Go back and look at your trial balance. You'll see that on the debit side, next to purchases, 12,000. And we're going to take that 12,000 and add that to our opening inventory of 0. Look at what you're doing at this point. Your sales revenue is 12,000. Your purchases expense is also 12,000. Income minus your expense gives no profit whatsoever. Okay, you break even essentially. But we know we sold those goods for more than what we bought them for. We brought them in for $5,000 and sold all those units, as it were, all that stock, for half of it for $6,000 and the remaining for $6,000, which should give you the $12,000. You clearly made a profit. However, if you leave it at this point, it shows that you didn't make a profit, which is not true. And this is where the closing inventory comes in, that journal that we discussed in the previous session. Now, closing inventory, we said we were going to credit cost of sales in the statement of comprehensive income, essentially to reduce down that purchases expense. So, find your closing inventory journal at the foot of your trial balance, tick off the credit, the reduction in cost of sales, and minus $7,000 from purchases in your statement of comprehensive income. What that is going to give you is total cost of sales of $5,000, which we bring into the total column, as that is cost of sales now complete. So you can see then that the cost of what we sold was $5,000. We sold it for $12,000. We therefore must have made a gross profit as a result. Okay? The cost of that inventory matched against the revenue generated from selling that inventory. That's the accruals concept, or matching. So then, gross profit is your sales minus your cost of sales. That is going to give you $7,000. Now what we need to do is complete the remainder of the statement of comprehensive income. That top bit is essentially your trading account, okay, your trading profit, your gross profit, before all your business expenses and overheads, okay, so all your other expenses. So, any other expenses then, and any other income also as well. Now, other income, there wasn't any other income for George in this question. Now, when we think about other income, we're thinking about bank interest that we've received, or maybe some rent that we've received, maybe if we have an investment property, but there is none. So, other income will be nil, but we do have an expense. Remember that rent expense account that we opened? You remember that was a debit balance in the trial balance, if you go and look back to that, and that was $450. So we're going to minus $450 from our gross profit being the expense of rent. Now, in reality, there'll be many other expenses, you know, electricity, gas, rent rates, heat, light, water, etc. However, for this example, we've just got rent. So, gross profit plus other income minus your expenses, in this case just rent, is going to give you profit for the year, sometimes referred to as net profit, and that is going to be 6,550. Okay, so George is making a net profit of $6,550 at the end of the 2 weeks. Not bad if you ask me. Okay, and there you have it. That's the statement of comprehensive income now complete. Now you're going to need this for our next session, which will look at completing the statement of financial position, and that will show our profit in there as well. Okay, so we'll go on to our next session and look at the statement of financial position. We're now going to have a look at the final part of the George example. And the final part is preparing the final financial statement, being the statement of financial position. Now remember, this is the second financial statement which will be presented to the external users of the accounts, along with the statement of comprehensive income, amongst other things. So, our statement of financial position then, you should have a pro forma in front of you in your notes. Now remember, the statement of financial position is as at, so a snapshot at a moment in time of the business's position. Now, we're going to be looking at here the assets, the liabilities and the capital. Essentially everything else on your trial balance that you haven't yet ticked off and accounted for. So we're going to start off then with non-current assets, and these are assets that we're going to keep in the business for a long period of time, generally for greater than 12 months, so greater than a year. So in this example then, that would be the motor vehicles or the delivery van. Look back to your delivery van in your trial balance at the bottom. We said that delivery van had a value of $7,000. Tick that off in your trial balance. That is going to be the cost of the delivery van. Now, our next column is accumulated depreciation, and we're not really going to deal with that now. We're not going to talk about it. It's only been 2 weeks that we're accounting for George, so there wouldn't really be any depreciation that we'd need to take account of. So we're just going to leave that blank for the time being, but in subsequent sessions after this, we will discuss this idea of depreciation in a lot more detail. So the carrying value of the asset at the end of 2 weeks is still going to be $7,000. So you can see then that we have a couple of lines, and essentially that's just to rule off the first 2 columns. So $7,000 is the total of the cost column, 0 is the total of the accumulated depreciation column, and then the carrying value or the book value of the asset at the 14th of April is $7,000. And you can see that we've underlined the first 2 columns. We don't need those figures anymore. We're only interested in the book value at the period end. So we've dealt with our motor vehicles then, our non-current assets. Now let's have a look at our current assets. Now our current assets then, we have a certain order. Inventory first, then receivables, then cash and cash at bank. We're going to start off with the inventory then. This is the inventory at the 14th of April, at the period end. So remember, this will always be your closing inventory, your inventory asset. So look back to your trial balance. At the foot of the trial balance, you'll notice we did that closing inventory journal. We already dealt with the credit to cost of sales in our previous recording. Now we're going to do the debit, the asset. So tick off the $7,000 debit to inventory assets, and we're going to pop that in to our subtotal column here. Trade receivables then, remember this is amounts owed to us by our customers, and at the period end that was $6,000. look back to your trial balance, you'll see $6,000 on the debit side for receivables, tick that off. We've then got cash at bank, and we said that was $43,550. It's an asset on the debit side. George has that money to spend in the business in the next accounting period. So, totting all that up then, 56,550 would be your total current assets. So we have our total current assets. We're going to add that to the total of our non-current assets, and that should give us $63,550 total assets. And that is the top part of your statement of financial position done. Now remember the statement of financial position. Our assets must equal our capital plus liabilities, which is the accounting equation that we saw earlier on. So let's finish this off then. At the bottom of the statement of financial position, we're going to start with capital, amounts in the business that are attributable to the owners, sometimes referred to as the proprietor's funds. So we're going to start off with our opening capital, and this is the physical amounts that George has invested in the business. Look back at your trial balance. You'll see that towards the top, $50,000 on the credit side, that's the capital. Tick that off. 50,000. We'll pop that into the subtotal column. Now what we've also got to do at this point is give the owners the profits attributable to them. Okay? Essentially the business owes that profit back to George. It's his money at the end of the day. It's his profits. So the profit is what we're going to use to increase George's capital, or the proprietor's funds. Look back to your statement of comprehensive income. At the bottom, our net profit was $6,550. Nice tidy profit at the end of 2 weeks. We're going to add that to our opening capital. It's going to benefit George, it's going to benefit the owner. So we add that at that point. Opening capital plus our profit, we will then deduct drawings. Now, drawings are amounts taken out of the business by the owner, by George. George did not take any funds out of the business. Therefore, we leave that blank. But if he did, it would be a reduction in his capital. So, total capital then in our total column, 56,550. Capital plus profit minus drawings is going to give you the total owner's capital at the year end, or in this case, at the 2 weeks ended. Finally then, let's have a look at our liabilities. We're going to start off with our non-current liabilities. This is liabilities that are due for repayment in a period greater than 12 months. So this is things like your long-term loans. Now in this question, George didn't take out any long-term loans from the bank. We didn't really have any long-term liabilities. So these non-current liabilities will be nil. But what we do have is current liabilities. Okay, what we owe in a period less than 12 months. So amounts due in the next accounting period. And all we have left really in the trial balance, if you've been ticking it off, is our trade payables credit of $7,000. So, trade payables, 7,000. is the only item left in our trial balance that we haven't yet ticked off. So that's our only current liability, so we're going to bring that in to the total column. And 56,550 plus 7,000 is going to give us 63,550 total capital and liabilities. Go and look back at your total assets, 63,550. It balances, it works. We're happy as accountants. So there you have it. We have done original transactions all the way through to the financial statements. And that's the way we prepare accounts. That is double entry bookkeeping. And this is essential. You must be able to do double entry transactions, to post these transactions into a journal, to post them into the main ledger, to balance those accounts, and then proceed to prepare your trial balance. And then once you've done that, prepare your 2 financial statements. This exam is all about double entry bookkeeping. You're going to see it not just now, but in every single session that we see from now on. What you must do is learn your debits and credits. It's so, so essential. So rework this example again if you wish. There should be another example just after this pro forma for the statement of financial position for you to have a go at in your own time.